Welcome to Short View Trading. It's your morning market hit for Monday, 9th of October. My name is Chris Watling. I'm the CEO, Chief Market Strategist of Long View Economics and Short View Trading. Now, if you want to trade equity index futures, S&P500 futures, FTSE DAX, etc., on a 1 to 2 week basis, that swing traders time frame, what sort of factors should you be looking at? How should you be going about making a decision as to whether you should be long or short those equity index futures? That's what we're going to dig into in this video. So let's get stuck in, because it's been a pretty dramatic few weeks in equity markets. The S&P 500, having topped around the 4,600 level intraday late July, has given back over 400 points as of last week, getting down towards its pretty close, touching on its 200-day moving average around the 4,230 type level on the S&P futures. That's quite a big move. That's just short of 9% peak to trough, with the Nasdaq moving similarly and other US equity markets equally under quite a lot of pressure. So the question is, what's been driving the market lower? And of course, what we've seen in equity markets in the last couple of months is another version of the taper tantrum. And as you can see in the chart in front of you now, if you look at US TIPS yields, this is the real bond yield part of nominal bond yields. So US 10-year bond yields, the market talks about them, the press talks about them, trading around 4.85, 4.90, are made up of two or three component parts. One, real bond yields, two, implied inflation, and then thirdly, a risk premium known as the term premium. And it's the TIPS yield that's been backing up and doing most of the work, a bit of the term premium as well. But primarily the TIPS yield, as you see on this chart in front of you, the third case of a taper tantrum in the last 10, 12 years in US bond markets. The first one came with Bernanke in the middle of 2013, when TIPS yields backed up on the announcement of the intention to taper QE. That was a dramatic move. It beat up equity markets at the time. The next one, a bigger version, was in 2022. In the first 9 months of the year, we saw TIPS yields back up dramatically, as you can see in the second red box in this chart that's up in front of you. And then finally, in the last couple of months, we've seen TIPS yields back up sharply once again by around 50, 75 basis points since July sort of time. So that's put a lot of pressure on equity markets. That's as a result, the equity market has been beaten up. The yield on the earnings yield on the S&P 500 has been moving higher to reflect the higher TIPS yield. The gap between those two is effectively the equity risk premium, and therefore that's been backing up the earnings yield to account for that higher TIPS yield. And with that, of course, we've seen the leadership stocks being beaten up over the last few months, as we've been talking about in these videos and writing about in our daily rag and our monthly publication. The likes of Apple, as you can see in the chart in front of you now, broke its downtrend a couple of months ago and has moved all the way back towards its 200-day moving average. Equally, Nvidia failed to rally on the back of really strong earnings in August and topped on them, which is a sure sorry sign that the stock is over-owned and there's no one left to buy, everyone's in. Or Microsoft or Tesla, and many of those leadership stocks that have broken their uptrends in the last few months. So the question is, where does that leave us now? What's next in this equity market? And when it comes to trading these markets, what's critical is our short and medium term trading models. The short term ones look at markets on a 1 to 2 week basis, the medium a multi-month basis. And when we think about the short term models and the medium term, they've moved dramatically since late July, when they were pretty much all generating sell signals. We had signs of frothiness in markets. There was exuberance. Everyone was very excited about equities, which is often the way at a local high. Whereas now, when we look at the models, there's much more interesting, much more a collective buy signal, both short and medium term. Take the put to call ratio that we're putting up in front of you now. This is a short term, 3-day smooth put to call ratio. Very dramatic reading on the level of puts last week. The put to call ratio got to a very high level. The chart's inverted. And as you can see, where we mark up those high levels, that tends to be as you're getting towards a major local low. This is one of many charts that we look at. It's interesting interesting. It's got a pretty strong message at the moment. For all the detail on those charts and to see how we're playing this, please see our daily rag, also known as the Rag Trader, that's published each and every morning around 9 a.m. London time. That has all the updated charts in it, updated view on market narrative, what's going on, how we see it, and a recommendation on what to do on a 1 to 2 week basis on equity index futures, whether they go long or short or just stand back for a bit and watch and wait. So what are we watching this week? Well, there's plenty going on. There's a lot of inflation data out, is the first key theme out of the US and China, both CPI and PPI over the course of this week. The market will focus on those. Inflation seems to be dissipating pretty fast in the States and is very weak in China. Secondly, of course, it's the start of US quarterly earnings season in earnest. On Friday, we kick off with the big banks, JP Morgan, Citi and Wells Fargo. That'll be watched closely. They're key, and that earnings season over coming weeks is critical. Then on top of that, of course, given the news flow over the weekend with the Hamas attack on Israel, the impact and response by Israel, whether or not the rest of the region's drawn into the conflict, the impact on the oil price in particular is critical. That'll be watched closely. Also perhaps an impact on the dollar. And then finally, other bits and pieces, Michigan sentiment in the States on Friday, NFIB earlier this week, all of this key macro data that we'll be watching closely. So that's it from us. That's your morning market hit for Monday, 9th of October. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button, like and share on social media. We'd be grateful for that. Or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe. Trade well.